It's not about timing the market, it's about time in the market. And it's proven time and time again.
People have different focuses for their portfolio, right? Some people want wealth generation over a long period of time, where some people really want cash flow.
I'd rather bet on people any day than bet on just some fancy, shiny thing like crypto.
Everything I've ever touched that I didn't have my hands on close to the controls has really disappointed me. In our lifetime, we will probably see a reorganization of the dollar to some capacity. Rents are going to grow long term.
You just kind of take a little bit of everything and then you make your own based on what's your risk tolerance, who you are, what's the future you want to have, what is fulfillment to you, right?
Taking ownership of your life.
Yeah.
Totally.
You know, and
defining it.
Becoming an active player in a space.
Welcome to the CashFlow Quest, everybody. Thanks again for tuning in and listening. We are going to just talk about what happened in 2024 and what the heck's going on and where the hell do we put our money in 2025 and have some fun with maybe some predictions for 2025. So Blake, why don't you kick it off?
It's fun. It's been an interesting year. The volatility, kind of the uncorrelated nature of the treasuries to the federal funds rate. And SOFR. And so it's been a fun year. So yeah, I don't know. Any comments as we're kind of going into this prediction and kind of what's been and where are we going from here?
Or what's the Fed going to do? How much do we think they're going to cut it?
So the market's predicting, if you look at future contracts, 95% probability that they're going to cut 25 basis points today. So that is really the consensus. So if they do anything outside of that, it will be kind of a shock to the market. What's going to be most important is the dot plot. So their predictions on what future rate cuts are going to look like for 2025. They've priced in, or the dot plot is showing 4 cuts for next year. So if we just kind of zoom back on 2024, they started the first rate cut with 50 basis points, and then they cut again in November, another 25 basis points. And then now today, hopefully another 25 basis points, which puts the Fed funds rate at 4.25 to 4.5%. So I think what is most important to look at, and this is, always the most important thing to look at, are 2 things in the data that the Fed really focuses on, which is price stability, which is inflation, and then full employment, which is just the unemployment rate. And the economy has been humming. And so inflation is still hovering around like 2.7%, like CPI. And so, I think that 2% is the neutral rate. That's always been historic. There's arguments out there that they increase the neutral rate to maybe 3% going forward. I think that is something that I've heard other CEOs and other experts talk about. I think it's probably the right move. I feel like just with the amount of monetary policy, the amount of printing of money that has just occurred over the last, call it 10, 12, 15 years, has just been astronomical.
Relatively inflationary.
Slightly bigger than normal.
Yeah. So I think that moving the target from 2% to 3% would make sense. I hope that the Fed does continue on this rate cutting path, assuming that inflation is, has a lid on it from some respect. And then in CPI, like we know, the rent data or housing data is extremely lagged, and I think that you can say all the things you want about CPI, but it's not a great way to kind of gauge the inflation, inflation, but it's what we have. So I do think that inflation, it feels like, is under control. I hope they kind of continue this path to cut. And then hopefully treasuries stay in a range bound, and we can maybe talk about predictions where we think kind of, 10-year treasury, we could pick our benchmark, whatever we want to look at, where they kind of stabilize at. But I think that this is kind of a healthy range where we're at. I'd like for the short end of the curve to get cut a little bit more, and then more of a neutral yield curve going forward, upward sloping. I think we're addicted to cheap debt. And people were wishing those 3.5 or 2 sub 3 days are back. I don't know that we're ever going
to see those in our lifetime again.
Well,
but
you never know. I'm not banking on it.
I know, me neither. Yeah.
So when was the first federal funds rate cut? Like from the FOMC?
This year, it was in September, I believe. Yeah, 50 bips.
So there was a lot of forward projection for like almost 2 years that not necessarily the dot plot from the interior of the Fed, the people that work there or on the board, but a lot of people in the markets were pricing in the federal funds rate to be cut for like a good 18 months before they did. And I think that was like an interesting kind of run because like everyone was thinking every meeting they were going to reduce and they never did. They held and held and held. And then they finally started to pull their foot off the throttle and step down in September. So it's been an interesting run through that. We rode the whole wave. I saw the beginning of it. We had a couple variable rate loans, some floating rate loans. We learned how to navigate. And thank God we bought some additional rate caps, which is like basically insurance for if the rate goes vertical, which they did. And so it was just really interesting how hard they went after it on the the rate hikes when they went as quickly as they did.
The fastest than ever in history. The Fed funds rate went up 25 times. So if you just think about going from 0 all the way up to 5.25, it hit the market. And that's why you see all these headlines on, the stress in commercial real estate and folks that, we were very fortunate. Our industry in general, like what you've educated me on, which just wasn't marketed. The floaters weren't as marketed to MHC, but apartment syndicators, there's folks that are giving up keys. I continue to hear more and more stories from buddies on deals that are just, they're going back to the bank. Investors are losing all their money on it.
Part of like the fun about the prediction of 2025 is where do we think the market's going to go? Right. And then as we kick off like the hypothetical scenario that we're planning to do, I'm seeing and I'm starting to have brokers ping me looking to sell a bank owned asset. And I haven't had that happen until now, like in the last 30 days. And it's December 18th, 2024. So that means, some of the conversations Ben and I have had with some different guys that are upper level, $50 billion, $100 billion, commercial real estate, multifamily groups. They are thinking that multifamily is going to go through a big transition. Ben and I were arguing like the next year, and they were arguing the next 3+ years on how much new product is being built in multifamily. So then housing in general to the slowdown and when that inventory hits the market. But then also maybe now we have these value add, lower level, lower quality assets that are bank owned. They're going to hit the market at the same time. Mm-hmm. There's some interesting times ahead in multi,
Well, and what does that do with rents, right? If more supply comes on from both old and brand new perspective, like, I don't know, it'll be interesting because we're seeing rents plateau in a way right now. And so, especially in multifamily, our space is a little different. So we're, unique, but in multi, it's going to be interesting to watch this.
The future of rent growth and the rent predictions or you're like, if you're making a 10-year pro forma model, it's a challenge on apartments specifically. Yeah. And I think what I'm hearing and what the people that I kind of look up to as mentors in the space is they're all looking to buy apartments for under replacement cost.
Correct. I was going to say the same thing. That's smart. I think if you're looking at a play in multi, if you can get in at a good basis below replacement cost, meaning the cost that it would cost for you to, construct that. Mm-hmm. Yeah. We were talking to one of those gentlemen that you were just referring to, and they're looking at, C and B class apartments that are falling in that exact scenario where they're bank owned or they're severely distressed, or, there's a motivated seller and they want to step in and they could see a quick kind of business plan value add. They have the cash to execute on. They're not making, crazy predictions on rent growth. They're just kind of going mark to market, getting to a place where they are right now. And then, obviously having a vacancy factor in there, and they like that. They're like, hey, if it costs, in this market, hypothetically $200K a door, and if I could buy this for, 125, $100K a door, like that sounds like a steal. And so there are some folks on the sideline. I think there'll be some good opportunities for that space. That's, if I was a multi guy, that's the space I'd be playing in. And that, I'm telling you right now, the smart money, the guys that are liquid, the guys that have seen 5 cycles, that's exactly how they're thinking. And they've been thinking about that. We've been having these conversations for over a year, and they're saying, yeah, I'm sitting on the sideline. I'm waiting. It's coming.
The cheap debt extended it and extended it
Yep.
and extended it. In hindsight, we're happy we bought the properties we bought, especially in manufactured housing communities, because I have a lot of friends that have been on the sidelines for like pushing 10 years.
Most every deal we buy is below replacement cost.
In our space, for
in our
sure.
space.
Yeah.
And then you can't replicate it in the locations. You'd have to go way more rural with mobile home parks to get it back in town. Like it just wouldn't happen.
Well, which is probably a big point why we're able to buy them under cost, because they're in towns that are very highly populated. And so to build something new in those locations is going to be way more expensive.
We just were insulated from that, which helps, but it also makes it more competitive and harder to get deals.
Yeah.
We have our own challenges. There's no doubt about that.
Yep. There's roughly 10 to 15 apartments to one mobile home park.
Which is insane.
At least
supply.
10, but I think it's probably more like 15 now.
And they really pushed rents, and it's not just plateauing. In some markets, we're hearing feedback that we're seeing much lower occupancy rates, and we're seeing huge concessions coming out from multi.
Yeah, there's a sign in our neighborhood. It's 8 weeks, they're advertising it as 8 weeks versus 2 months. It's all in the language.
You get to live here for free for 8 whole weeks.
Yeah, sounds like a lot longer.
Yeah, but that's a big deal. Like,
what are they collecting, like salons now?
I know.
Just to go back from an economic standpoint, you're talking about changing the neutral rate. And these are some questions. You're our economics professional.
Oh, gosh.
So with the neutral rate, don't they usually try to have GDP pair with that? Like at a minimum, the GDP needs to be growing by that neutral rate. And so that's partially why we haven't seen it go up, because obviously like the exiting administration, they're not going to be able to grow the GDP 3% per year.
The Fed has a dual policy mandate. So they only have 2 things that they're guided by. And the US is one of the only monetary policies that has actually 2 of them. Most of them is just full employment. And so the more important thing that they are looking at on when to increase or decrease rates is inflation. So the Fed has a lot of tools in its toolkit, and they've created new ones, and they've shown that they've proven over the last couple of cycles that they work. But they're very concerned that if they cut too fast and inflation starts to run, then they need to essentially recorrect and start, increasing the Fed funds rate dramatically. And that will put us into a recession in order to control inflation, because they don't want to have runaway inflation. That is their biggest concern.
I'd say they're happier with Biden just because everyone got scared and everyone stopped spending money. Well, everyone got fearful of the unknown of where the market was going. The government seemed like it was being run by nobody.
But they were doing these huge omnibus packages. So like the American taxpayer wasn't spending money, but the government was spending unlimited amounts of money.
I think this is like the essence of the Biden to Trump era change was my buddy works on yachts. And he's like, I'm starting to get a little quiet, going into and he had plenty of work. So he was like, fine. But he's like, I could tell going into the election, people were holding. And he's like, literally the next day after Trump won, he got 10 calls with like huge contracts.
Wow.
The next day. And he's like, it wasn't like the next week. It was like my phone rang off the hook the following day. Everyone was holding to spend the money on their boats until after that election. And it was the deciding factor. Throttle on, spend the money, party on, or we're going to have to go back to being defensive.
The other piece of that, and I think the presidential election has some impact to that because of Trump's. There's other ways you could re-gear the economy besides just interest rates. And the other one is like taxes, right? And so because of the tax cut, that stimulate spending and can cause some sort of inflation. But if they go too slow as well, then they'll choke the economy. So they're like trying to play this fine line right now. And it goes back to my earlier points that I feel as if they go on this modest kind of rate cutting and kind of keep expectations and keep the market, in its current state, that would be the best scenario, because I don't think that inflation is just going to run away. I don't think so, especially if you have a lot of more onshoring. That's, that will kind of help with keeping kind of a lid on some of the inflation. But to your point on it, talking about the market and people spending, that's probably why today when they come out, they're probably going to taper back, because they probably think that the animal spirits, is when they're called on Wall Street, are coming out, and people are going to get greedy and things are going to get.
Bitcoin's going to $1 million.
Yeah. It's going through the roof.
Yeah.
Well, that's why it's just kind of like, I'm kind of curious on one hand to like, what if they do cut it 50?
That'd be awesome.
I'm going to predict, just for the fun of it, that they cut it 50 bips.
Okay.
And
half a point.
I'm curious to see that roller coaster ride. I'm taking it. I'm taking the high bid.
I like it, Jen.
Okay.
I'm with you, but I'm gonna go 25.
I hear the other side. Yeah.
All right. I got a hot take. I'm gonna go 25. I think that Trump's going to affect the economy so much because we're at historic low interest rates. We kind of forget that, like, even though interest rates are, kind of coming down in this, like, it's crazy.
They're expensive for us right now, Ty.
Yeah.
We're used to 3%.
They're going up. Like, I don't see us cutting for years. Like, they're going to go back up.
And if there's 4 more cuts coming in 2025. That's what they're saying,
but that's based off of an economy that they don't understand yet.
And so they might not necessarily cut it.
I'm going to go 0. I think if I was the Fed, I would be freaking out. The shift that occurred, like I'm saying with my buddy and the boats and the spending back on, I would probably hold and see what happens. If you go back to like the generalized decision that's at hand, that's my prediction. I think that 25 is more likely.
Totally.
I hope for 50.
Well, okay. I know. And I'm just taking the long shot, okay? Because it's fun.
Hey, let's put some money on it.
That's right. How much you want to bet on this? But okay, if they cut it, what do you think is going to happen to the 10-year treasury if it goes 25 or 50 or 0?
That's a whole nother bag of worms. The treasuries are not following suit necessarily.
Right.
And so that gets more into the macro dynamics with the whole world and what's going on in the different markets and what's in I'd say the overall sentiment and confidence in being in the markets, being away from treasuries, or do you go defensive and go back into treasuries, which would drive treasuries down?
So what do you think the 10 year is going to do then?
I think I'll make a short-term prediction. I think we're going to have this like up and down of like a quarter point, maybe even to a half a point, which is pretty crazy.
Yeah.
Short-term, half a point is a lot.
It's a lot.
And so that's been sort of like the year this year. They were up and then they were down and they were up and then they were down.
I mean, even if you just look back the last like 6 months, I think it touched down to 3.75, the 10-year. And then now it touched like 4.5. Right. 4.6. So that's almost, and that's just in a short
75 basis points.
I mean, we look at them almost every single day. Right. And the volatility on the rates is pretty, astonishing.
Historically, I never looked at the treasuries because they were moving like 10 bips here and there. Like it wasn't as volatile at all. Volatile.
Yeah, no, you got
it. So it's going to be interesting. Okay. So my short term is that they're going to be bouncing around through January 20th. Just because everyone's freaking out about the 20th.
Sure.
Whatever that means, I am a low-key prepper, but I don't think my prediction is that nothing really happens. Setting that aside, through January 20th, things are going to stabilize. Whether that means rates go down, I think treasuries are probably going to be roughly, I'm talking specifically the 10-year, just to give a benchmark. Is going to be around 4. I'm with you. I'm with Ty that like we got so addicted to the lower rate stuff that I think that things are going to stabilize around 4-ish. I'm hopeful that it goes down for business. It would be good to be able to refinance or do some stuff and maneuvering with lower rates again. But I think that 4% is kind of here to stay for the next few years.
Yeah.
So for our professional friends in the industry who are going into loan season, rate locking? What are some things that you think are going to happen for if you're sizing a loan right now with product?
I really think if it's 6% or under, take the bird in hand on the fixed rate and potentially go 10-year, 10-year fixed. We're taking lower leverage loans than we ever have seen and or been willing to take. And we're putting Ben to work, raising more capital because we would all like to sleep at night knowing that we have more equity, even on the front end, reducing risk, reducing the payment costs. Roughly our interest rates today are 5.5, give or take maybe a quarter of a point based on the treasury movement. So like 5.5%, that's a good rate historically.
It's a very good
and
rate.
So we're trying to hold to like more of a long-term historical opinion on like, okay, 5.5, not a bad rate, especially if it's lower leverage. We're taking 10-year interest only, so that it just stabilizes your cash flow, and leaning into that cash flow, more of that conservative play with the loan product. We don't want to become this company that's highly leveraged and dependent on debt indefinitely, because the debt markets are shifting. And so I think that our overall sentiment and our shift this year, we're putting more equity behind deals. We're still making a decent cash on cash, 5 to 6%. I think that that's more important to be defensive going into the next few years, even though I think the outlook is positive in the big picture. The debt is not going to be easy for Elon Musk and Vivek Ramaswamy to reorganize. It's $35 trillion. It's a lot of money. And it's unprecedented debt levels, to where I think you take a bird in hand, fixed rate, and you go longer term.
And one question I'm going to go back just slightly for the listener. Why would you choose to go interest only as an option?
It just helps with cash flow. And then the longer the interest only period you take, the cash flow is just that much more predictable. Then when you go to a 30-year amortized payment, the payment's significantly more and you don't pay it down that much in 10 years.
Right.
And we don't take 30-year fixed products in commercial real estate. Most of us don't. To where it's better to have interest only and just game plan the cash flow element. And then at the end of 10 years, there's going to be a debt product, whether it's life companies, CMBS, commercial mortgage-backed securities is what that stands for. The agencies, like there's going to be a debt product. And then at that point with our rent growth projections, it'll be so low loan to value on the 10-year that we'll have the options that we want.
What you do is you de-risk the investment by fixing your interest rate. It pencils based on what your interest rate you're going in at today and the cash flows today. You don't put yourself at risk for like a credit crisis or a credit crunch where you're trying to financially engineer the returns by getting floating rate debt and predicting what the world economy and the Fed are going to do. You kind of move all that aside, just focus on the real estate and driving value on the real estate based on some conservative assumptions. And then you have the upside that if you do raise more equity and you have a lower loan to value, and say rates do crater, we go into a recession, and then we're okay because the property's performing and it is affordable low income, affordable housing. So the stability of that tenant base is really strong. And what you do then is, if you do go into a period with low rates, you could refi, and then it allows you to then, cash out, refi, redeploy capital into new deals, pass capital back to investors. So I'd way rather be in that position and say, hey, it might be a lower IRR or AAR than if we were juicing this up to 70% loan to value and we were taking on some variable rate, some introductory rate product. To me, I would just, like you said, I think it's a perfect example. We talk about in the office all the time, bird in hand, and you have to, and then you just continue to go down the road and just make sure you buy good real estate that pencils right now. Pencils today and great locations. It's not about timing the market. It's about time in the market. And it's proven time and time again.
People have different focuses for their portfolio, right? Some people want wealth generation over a long period of time, where some people really want cash flow. And ultimately it comes down to the cash flow play, which is the whole point of this podcast. So you're going to get more cash flow if you're going with that IO loan product. Yeah. I want to plant a seed, maybe for a future episode, a debate on you made a comment that the Fed has a lot of tools in their tool chest. And I would beg to differ. I feel like they have basically one tool, and that's manipulating rates. And there's a lot of people, a lot of economists on the other side that would say that part of the reason we're in these different issues are because of the Federal Reserve.
Yeah, so they can increase the Fed funds rate up or down. They could do like Operation Twist is what they instill. Yeah, so like they could buy.
Let's do the twist.
Yeah, they can buy long-term treasuries. So they could buy treasuries too, which effectively puts more yield pressure on treasuries, whether up or down, buying or selling. If they sell, then yields go up. So they've done that. They're able to print money. It can be debated, but they've proven that they can get creative when things happen.
I don't know if it's proven that the Fed is able to control this economy completely. I'll tell you a little story. I went on a horse ride once, and a hawk flew out, and it scared my horse. And up until that moment, I thought I was in control of that horse. And then I realized I wasn't. And I kind of feel like that's Jerome Powell right now on a bucking bronco. And he's got these, couple things he's holding the reins.
Some strings he
but
can
at the end of the day, the world economy, all these things have an additional influence. And I feel like sometimes the meddling ends up causing an issue down the line that we don't really see it in this moment.
It's a chess game.
And I think too, just like overarching, if you're worried about the hawk, coming out and scaring your horse, you're never going to get on the horse. Right. And so I you can kind of sit back and be like, it's doom and gloom, all of these things. And you just sit on money and you watch it get inflated away and then the stock market's up 20% this year. We generated great returns in our portfolio. And you're like, oh, I missed out. But these guys are idiots because it's all going to come and crash and burn. And you just don't want to be that person on that. And I'm not saying you are at all, but you want to, I'm just saying that, I believe in.
I'm glad you believe in the Fed. That's a good thing.
I believe in the U.S. economy. I believe in our institutions. I do. I mean, I have my, I can criticize certain things, but I think it works pretty well.
Have you read The Creature of Jekyll Island? Anybody should listen to that book or read it. But
what's it about?
I like to listen. That's the initial moment in 1913 when the Federal Reserve was founded by the main banks.
Yep.
And they went out on the island off of South Carolina, I think, and it's called Jekyll Island.
Jekyll Island, yeah.
And I think either JP Morgan or somebody in the family in the banking realm in that heyday, the big names of banking, they went out and they decided to found the Federal Reserve, the central bank.
Yeah, it got founded a couple of different times. Like, some of them
got shot down in like 1910.
Yeah.
They got another president in there, I think. And then 1913, they got it through. And it's really interesting. I think that's Tide's point, is just the Fed's effectiveness versus another form of control. But to your point, it's what we have. We got to play ball with the dynamics at play. And I that's why I'm really defensive by nature. It's sort of how Dad and I and Jen, we got into this, is like we started pulling these books off the shelves and you go, inflation is going to run, in the long haul. It's going to be cyclical, higher percentages, low percentages. But when you measure the dollar against gold, just as a metric of measure since 1971, it's devalued and it lost its purchasing power to 96% of what it had.
Mm-hmm.
So, and then what happens is it exponentially continues from 96% until the United States dollar as we know it will eventually be reorganized, or else we'll be throwing around $1 million bills. And so that's where I think he's coming from, is like, really, what is the Fed doing? And the Fed's like, federal government, you can hardly pay the interest on the debt as we see it currently. We'll just go ahead and give you another $1 trillion. And, the interest rate, by the way, is going up on that. So, sorry.
Yeah. Good luck with that.
So we're skating on pretty thin ice.
It's modern monetary policy, right? It's the Elizabeth Warren, a lot of but she's talked about this when she was a professor at Harvard. It's a lot of governments are using this, debt play and modern theory that we're seeing. And I don't have 100% faith in it. So,
well, this will come full circle. But if you were in government, we would probably be saying the same thing because your hands are kind of tied. Once you get on this debt kind of treadmill, you can only push growth so much. There's only so many buttons you can hit for the economy in order to throttle out of the debt. And one of the best ways to get rid of the debt is debase the currency and basically lower the amount of I call it paper, but the amount of debt and the amount of dollars that you're gonna have to pay back. In general, our GDP and everything now in dollars has gone up because of the inflationary piece. So it's a whole thing, but we have what we have. And at the end of the day, it's going to be fun in our life to see where it all goes.
Yeah.
So we've picked a very defensive multifamily asset that I think all four of us appreciate for different reasons. So we have a lot of clients that we start engaging with, and they kind of come from different angles, whether we get a referral or we bump into people, higher net worth folks. I'd say, our typical client is roughly 55, 60 years old, and they've owned different businesses. Maybe they've exited a business and sold, and they have some cash, or they have a bunch of rentals. They have different holdings, and it kind of goes across the span of all things. I'd say, entrepreneurial, blue collar business owners, you name it. And what I'd like to put forward to the panel here is a $10 million hypothetical, which doesn't matter what you sold or what you have currently, but let's say you have $10 million of available equity or cash, and you are going to make decisions on the allocation, and you need to live. I mean, ideally you live on some cash flow from the 10 million versus just spooling up equity in something that you can't really live on and then you have to sell. So you could choose that option, but I think that'd be kind of interesting and a cool
what's our opinion
discussion
on how to place it then?
I think what I would do if someone, and I'm speaking, and this happens too, the first thing that I ask is like, what's your monthly burn? Right. So what do I mean by that? Like, how much money do you spend a month? How much money, cash flow do you need a month to sustain your life? It's generally around $20,000, right? 20. And that maybe sounds shocking to some people, but I have clients say, I kind of budgeted $20,000 and it's not enough, right? Because everyone has different lifestyles, right?
In San Diego, I mean, that in order to live here, you need about $250K a year is what they say in order to afford a mortgage. So I think that ties right into that.
Mm-hmm.
Yeah. And I think even if they don't even have mortgages, a lot of these clients, they don't, they own their house free and clear, but it's just the burn of just, keeping up the life. Yeah. Living,
going
right?
Trips, whatever they're doing.
Sure.
Yeah.
Mm-hmm.
And so once I would find out like basically like what your monthly burn is, right, then I would say, all right, we have to solve for that first.
Mm-hmm.
So if someone said it's about 20K and it's 10 million bucks, I would say, let's make an assumption that you can get 5.5% cash flow from real estate. And I would choose real estate over bonds or CDs or anything like that because it's more tax advantaged, right? So I would say, all right, if that's the case, you probably need to allocate $4.5 million. That gives you about $250,000 in cash flow a year, which is about 20K a month, roughly. I mean, very rough round numbers, right? So $4.5 million, I'd say I would park that in cash flowing, producing, core plus real estate. What do I mean by that? Stuff that doesn't have a high risk to it, right? That's more predictable.
That's going to be conservative with their cash flows and like very, very regular, I should say, in the cash flow. You get a check in the mail. We do monthly, but some organizations do quarterly. So you're going to get a consistent kind of cash flow from placing that 4.5 to 5 million in a core plus asset.
Yep. So that'd be my first. I'd start off there first.
So
right?
call it half, the 10 million.
Yeah, I'd say half.
5 million.
I'd put in really good real estate, whether it's passive like through us or active. If you have the wherewithal, the energy, the expertise, the resources to do it, then that's what I would do first. And then after that, I would say, okay, what's your risk tolerance, right? I'd have to know where your risk tolerance is. And what are you trying to make 20 or 10 and a 30 and you're okay with some bumps and bruises along the way? Or are you looking to preserve and just grow that steadily? right? And be comfortable in 20 years, your 10 million being worth, call it 15, 20 million or whatever it is, right? I said 20 years, it's kind of a long time, but
yeah. And that's two very different paths.
Yeah.
Depending on which one you go.
It's a blink.
So once you kind of understand where the risk tolerance is, then I would probably gear my next couple of suggestions. But let's just say like myself, right? And I would say I'm more risk averse, which just means I don't like a ton of risk, right? That's why I'm in the space I'm in. But I'm young and I know I have time on my hands. So I'd keep some money liquid because you never know. I'd want money liquid. So I'd probably keep 2 million, at least $1 million, but let's say $2 million liquid. That would be short-term securities. That would be liquid, something that's earning interest. And then the rest, I would either put it in something that's more risky, whether that if I'm a real estate guy, then I'm doing some value add real estate. Maybe I'm doing something that's sexy, interesting, kind of, that excites me. Or I'm putting it in the stock market and I'm not checking the stock market. I'm just putting it in there and I'm forgetting about it. And I wouldn't do any bonds because I already have my income for my core real estate, which I would look at as kind of my income producing my ballast, my stability in my portfolio. So I wouldn't do any bonds. And then I just use that remaining $3 million to go risk on, and whichever flavor, like, invest in what right? So for me, I'd probably go more heavier, like value add type real estate. Or like stock market, just ETFs, broader kind of easy stuff, set it and forget it. And that $2 million, I would use that $2 million just to make me feel safe and secure. But then if there's a unique opportunity, the market crashes, something like that, you want to have some money on the sidelines. That way you could jump in and get a discount. So that would be my general.
No oil and gas?
Not me. No.
No energy?
No energy. No, I don't. I don't know.
You'd get some of that in the S&P, I'm sure.
Yeah. And I don't know it well enough. Right. So it's just basically I would be basically taking the advice and expertise from somebody else. If I knew someone who's really badass in it and had a track record and just was going out to the fields, was with the refiners, or was like, hey, no, I'm on site. I know these guys, they had a real relationship. I'm familiar with the board. Like if they were an expert, like how we are, I would consider ourselves experts in MHC, right? Then of course, like I would make a bet on somebody. Like I'm better at making bets on people than I am on
yourself in certain industries.
Well, I'd rather bet on people.
Totally.
I'd rather bet on people any day than bet on just like, some fancy shiny thing like crypto right now, which is funny.
Bitcoin.
One thing that I will say, and I would have never thought that, and Blake talked about our clientele. I would have never thought in a million years that we'd have so many of our clients that are in Bitcoin. But now that it's at 100, I just hear, oh, Bitcoin. And I invested in that early on and made some money. It wasn't very little, but back in 2016, I invested in it and I sold it to buy my wife's engagement ring. So it did help me. But anyways, that would be my kind of 2 cents.
All right, Tide, how would you answer that question?
Well, I think 60% would be in real estate, and I would break that up. 30% would be in low income housing, ours specifically for the tax advantages. And we should talk about that.
Right.
Because that's a good segue on some things that I think a lot of our investors want to know. But 30% would be in MH. 30% would be in residential real estate. I think it's just, for me, I like being able to drive to a rental, and I have, a lot of family in San Diego. So having, I don't need to make some huge cash flow play, but long-term, I do think that San Diego real estate is going to continue to go up.
You'd have a slice in like residential, maybe some ADUs like on those,
however
single-family rentals.
So this would be $3 million in MHC, $3 million in residential rentals or something like that.
Yeah. So maybe your house would qualify as this, right? And then maybe you've got a couple rentals. Okay. And then I think that you should probably have 20% that's working for you in the market. And I'm talking very safe S&P 500. You also could be, what would qualify in this is like maybe you've got some large life insurance policy that's also in the S&P 500 and it's kind of feeding itself like, full life, not term, something like that, so that you even are leveraging on that after you pass away or, later into your life. That's something that I have in my portfolio. And then the last thing is, so what am I at? I'm at 60, 70, 80. So I got about 20% left. 10% would be in gold and art. I like art. It's something I've been like learning more about. I think it's a really interesting thing. And obviously gold is a no-brainer. The only issue with gold, now I do have some ETF and I want to also bring in some like actual physical gold, but I think that it's just a good hedge against the market. It's something that's not as affected. It's not swinging up and down wildly. Yeah, we've seen some increases in a turbulent market, but not anything that's insane. So just a good hedge. And then the rest would be in some type of liquid cash. That's how I would probably break up my money, cool. My 10 million.
Okay, so I agree with pieces of both of you guys. I would put at least half. I would say probably 5 to 6 million in cash flowing core plus, pretty safe, lower risk, in my opinion, to get that consistent cash flow. 4 million in mobile home park, this asset class, and I'd probably put 2 million in like residential real estate, like apartments, or something like that, to give me a little bit of diversification, but it's still safe in my opinion, with like a being pretty low risk and a consistent flow of cash flow. Mm-hmm. And then I would definitely buy some gold, because I agree with you. I think it's a good hedge for inflation and just the economy. So we've had good success with gold, especially recently, but you know, it's been an interesting time in the market. But I'd probably put like a couple million in gold, and then I'd do $1 million in the market, and I'd keep $1 million cash just to kind of have and play with. I like the market. I don't know a lot about the market, and I'd probably go with like a conservative S&P 500. Although, you know, it depends how good the cash flow is over here on this 6 million of how risky I might be on this $1 million in the market, you know? And so I do think I bet on people too. And so if I knew somebody that really knew like an energy source, or, you know, solar is continuing to be a big thing.
Or like some venture capital stuff, which we've all done, you know, like some businesses investing in other people's businesses, like that has a really good, you know, they're business savvy. They have a track record. It's a good idea.
I'd
stuff
play
like that.
With that $1 million, with that type of stuff. That's maybe higher risk, and then have $1 million in cash, just because you never know.
And I think you just made a great point in that once you have that ballast, or, you know, that stability, you could take the risk.
Then as that cash flow from the real estate investments continues to grow, I might not need all of that cash flow anymore. And then that's more dollars that I would then be willing to play and be a little more risky, and like a venture capitalist play or something like that. So yeah, that's what I would do.
Cool. I was holding my poker face, trying not to sway you with my looks.
Blake, what would you do? I think I know.
Yeah.
I would do everything I've ever touched that I didn't have my hands on, at least really close to the controls, has really disappointed me.
Amen.
Yeah.
And people that I would really look up to in the financial realm are the same way. They really made most of, if not 95% of their wealth off of where they had their hands on the controls directly. Mm-hmm. And so I would say I'm in my 30s now. I wouldn't do 100%, but I'm probably 80 to 90% in affordable housing and mobile home parks in markets that I believe in, because I've done the research and I get it and I understand the game. I know that I'm clipping a bond level coupon, 5-6%. The bonds have been up and down, but and I have the appreciation growth that I believe in, because I think in the end, in our lifetime, we will probably see a reorganization of the dollar to some capacity, meaning rents are going to grow long term. Things are going to get more expensive long term. So then I'm happy knowing that my valuations on mobile home parks are going to grow little by little, be a little bit of an up and down, not a straight line. But I'm sipping on 5-6% cash on cash. I pay hardly any taxes because of the depreciation. Over the long haul, I'll have to continue to cycle deals, get into new deals. But then, so I'd say I'll commit 90%. I go there and then I manage that holdings effectively. Mm-hmm. And then 10% in my 30s, I like to have some liquidity. And being that I've been buying mobile home parks since I was 19 years old, we have had moments where we didn't have any cash.
Yeah.
And we're all hard asset rich and cash poor. And it's always been this like, okay, we need to square up. And we've been significant in the last few years. We've been pushing to have a meaningful amount of cash to chase deals with, chase opportunities that present themselves. And now with some of the volatility in the market, we can hedge. I like sleeping my head on big gold bars if I can, you know.
So is that part of your liquidity?
So liquidity
situation?
equivalent would be cash and gold.
Like, would you say 50-50?
Yeah, I'd probably do like $500,000 gold and $500,000 cash in this 10 million hypothetical.
Yeah.
Because it takes a few days. What I love about gold, which people don't fully understand, is you put it in a vault that's privately owned. You pay for it, you insure it. Even if it burns down, gets hit with a bomb, you have insurance coverage because it's in a vault that allows you to buy that coverage. And I like that it's not in play. Being that I'm a very kind of active player, we use the DISC assessment, but like I'm a salesperson at heart. I like to go talk to people. I like to move and do a lot of things. And I buy a lot of toys and fun things. I don't want cash sitting around, even with the team and the company. I don't want a bunch of cash sitting in bank accounts that could be potentially tapped in. I like gold because it gets it out, and a few days transactable causes us to ignore it and not put it in play a lot. Yeah. So I like that additional layer of complexity to
get forced savings, right?
It's forced savings that it also hedges just in case, which we saw this year. And then I let, it's not really an allocation, but I also think that life insurance is a big thing for our life. We are all going to die. I think it's important to realize that. And the sooner you realize that, the better, because you can buy life insurance a lot cheaper and it can become an investment vehicle. So I'd say that's my 90-10. I like to keep my hands on the controls. Everything else just kind of annoys me.
If somebody was in their 60s and they're they've had this portfolio, they have this money, and they're really kind of more cash flow driven, and why we like real estate versus like bonds or, REITs or other avenues of investment, specifically from the tax angle, right? Because like a lot of times people, I'm going to use real estate and bonds, for example, where like cash flow can be fairly similar at like, call it 5%, but they're very different. And the depreciation aspect from real estate investment in mobile home parks, and then Tide and I were talking earlier, like there's a difference too if you invest in apartment communities versus mobile home parks. And so,
or triple net, commercial, industrial, how much do you need to live on? So like that's Ben's point.
And I think that's an equation that everybody needs to grab hold of, right?
And you need to, if it costs you $20K, now you have to go to 30 in order to make sure you pay the taxes at the end of the year.
Right. Yep. So in our real estate hypotheticals that all of us were just talking about, like when we say, 4 or 5 million to get you a net 20,000 a month, that's a net cash we're talking about, because the depreciation from these investments will cover some of that and when you file your return. And so it really is a net. Now, everybody's tax situation is slightly different, so that's a loaded kind of comment. But we do like this space because the depreciation, there's no taxes. It's called tax deferred. So, unless you sell or there's a gain, then you pay the taxes at a later date. But with a bond, if you're going to get a 5% cash on cash from this bond every year, and I actually don't know, Ben, you might be able to clarify this. Like, I don't know, every year and with your tax return, you pay tax on that, or is it through the term?
No, it's every year you'll file on the income you receive during the year.
And you're paying tax on all of those dollars.
Unless it's in like receiving. A 401k or something. But
then you get taxed when you draw that money at a later date. So you're still getting taxed one way or another, which is why we love this space. And mobile home parks specifically, the depreciation schedule is one of the highest in the industry, because we're seeing 70 to 80% of purchase price that can be depreciated and given back to the members associated with
under 15 year depreciation, that's the big swing of the needle. The faster that you can depreciate a real estate asset, the more tax benefits that it's going to have year over year. And so you just, basically you want to front load. It's under 15 years. That means if you own it for 15 years, you're going to have different buckets.
5, 7, 15.
Sooner you can front load that, the more that real estate cash flow is going to be tax efficient.
Mm-hmm.
And then it's basically the way to simplify the depreciation game is the less you have built above the ground in improvements, the better off you are.
Right.
Because we just allocate let's use an Arizona mobile home park, 10 acres, 100 mobile home sites. We don't own any of the homes in a normal deal, let's say. We own the water lines, the sewer lines, the electrical lines, and maybe the gas lines, unless it's a third party provider. And we just lease, or they have an easement to operate their gas system.
And then add in the streets and like one common area space with like a building and a pool, right?
Right. And so now when you do a cost segregation study down to the hose bibs, you have all these you have these improvements that are really infrastructural and they're called mechanical improvements. Mm-hmm. And mechanical improvements, because of their mechanics, they wear out faster. So plumbing systems, electrical systems, all that, which we deal with too.
Yeah.
We deal with aging systems all the time.
Yeah.
And that's part of the challenge of operations and making sure that we do a good job on the due diligence piece. But the less you have above the ground, the better off you are on the write-off. And so apartments, you have like half of the front-loaded depreciation that we have, roughly. I'm making generalization here, but I'm pretty close. It's probably 40% or so under 15 year.
Right.
And then the rest is longer term.
Going to fall into the buckets of 23 and 27. And just to clarify too, like a cost segregation report that you just mentioned is a way to have a report that segregates the cost of the total value of the property. So they put this inspector that'll go out, will give a value for the infrastructure and a value for the building and a value so that it can be separated into these separate buckets on a balance sheet.
Yep. And so then to put icing on the cake of mobile home parks, which we have some legit billionaire friends that are now buying mobile home parks just for the write-off.
And the depreciation that they get that like covers.
Cat came out of the bag over like the last cycle on why they're so great for that. And then the icing on the cake is, let's say we do inherit some homes with the ownership. The homes are personal property and they're 5-year write-offs.
Mm-hmm. So it which accelerates is insane.
It's basically a travel trailer or a car equivalent, but it's a mobile home and the accountants can write them off in 5 years. Mm-hmm. And as long as we don't sell them off and like cause a gain in those 5 years, you write them off and then you sell them.
And really, like what you're talking about too, it's a tax deferral game. So it's not tax avoidance. You're deferring the taxes, but it's a time value of money equation where you'd rather have $1 today than $1 tomorrow.
Right.
Because you got $1 today, you can invest it or do something with it and it's more valuable the next day, right? So you want to shelter income or gains. You want to shelter as much of your cash flow as possible on the front end. And then in later years, hopefully you get in a lower tax bracket, or you could use things like 1031 exchanges, reinvesting. And so you constantly kind of kick this can down the road. And just sticking with real estate specifically, why it's so amazing is that, they allow, the federal government allows for what's called a step up in basis. So if you just continue to play this game and keep more money in your pocket today, and then use that extra money you have in your pockets and then grow that money into more. And then when you go on and pass away, if you have kids or, there's a foundation you want to donate to or whatever your legacy is going to be, once you pass, you could pass that on tax free underneath, as long as it's under the, estate, the estate tax.
Sure.
Right.
And that limit.
But you'll get a step up in basis where at time of death, you'll get an appraised value at whatever the value is of that property today. And that's where your tax basis will get moved up to. So you could hand over real estate assets to your kids, effectively tax free. So there is a way to do it tax free. That's the way. And it sounds a lot easier than how we're kind of outlining here, but it's real. And I'll tell you what, this is something that I came from a tax exempt standpoint, right? Like all the clients and where I grew up, in my start of my career, no one paid taxes. Their pension funds, their foundations, with their 401k plans.
So that means all the returns you're generating go into these pools of money.
And they're not worried about taxes because they're not getting...
They distribute to their shareholders, whatever you'd call that.
And on the back end, the actual people that pay taxes,
Okay.
but those entities, they're not looking at, oh, should I sell now or should I continue do a 1031 exchange? They don't do that. They're just trying to generate as much value because they're not getting hit with taxes. They're tax exempt entities. So if you are not a tax exempt entity, and if you're a human being, you're not. So it's extremely important to understand taxes in a way. And none of us are CPAs, but we rely on really smart people.
Yeah, we're not financial advisors either,
No.
but we just have had a lot of experience with our own investments and talking to other investor clients of ours. And so it is super important
And
to
tax-
understand this. And
yeah.
you can there's so many ways to do this and get creative to save tax dollars so that you can use 100% dollars to live whatever lifestyle you want.
Yeah.
Yeah.
Let's take a quick step back. So we all went through what we would do with $10 million, and every single one of us was real estate heavy. You were 90, we were both 60. What was your?
I was like 50, 60.
Now, I'm sure it's a little biased because you're interacting mostly with clients that we have already, but it seems like when I bump into people, kind of the first step is they have their house,
Mhm.
right? And they have their job, and then they might have like a 401k plan, or they maybe have an index that they've invested into.
Mhm.
But it seems like that's more common. Like actively investing in income producing real estate seems to be not as common when I'm talking with the lamest person. Would you say that that's kind of common with the people that you interact with that are not already investors?
Yeah, absolutely. And I think a big part of that is like the priming around like the 401k system and all of that you kind of grow up on. It's like, hey, you go get a job, they have the match.
Propaganda machine.
Yeah, right.
Well, it totally is.
You invest all this money into a 401k, and then one day you're going
Get to work.
You're going to be rich enough to retire, and you're going to use that money for retirement. But it can work for some people. I think if you don't have the means or the wherewithal, or maybe just the eagerness to learn the game, then it's a good get out of jail free card or a good solution.
Totally.
But I think that it's kind of ridiculous that if you're going to sit and plan your retirement around like a 401k, a defined benefit or a defined contribution plan, meaning you're only going to get what you put into, and then whatever that market generates. And there's a lot of fees associated with that. A lot of people don't even know what they invest in.
Somebody the other day was telling me that they had a friend that had worked their whole career, had like $1.5 million in a retirement benefit account, and they didn't realize that they could move it.
Yeah.
It's a whole obscure realm.
Well,
If
and
you
they
don't really actively go into
And
it.
$1.5 million in retirement is not going to get you anywhere.
So she wants to, I think it was a woman that had it, and she now is looking into becoming a self-directed piece with that money so that she can deploy it and actually churn a revenue, because you could live off the interest of that if you were living, depending on your house situation, all that.
Yeah. I mean, you could definitely, but I'm thinking about medical expenses and so forth. And I don't mean to say that I'm more talking for more younger folks that are more in control versus talking to someone that might be listening. It's like, like my mom doesn't have any money, and, maybe she has 20 grand or anything like that, but, I'll help her. So it's not like I want to talk down on that. But if you're a young person who's got a lot of working years ahead of you, I would say, the sooner you can realize that it's more important now for you to take control of your financial future by focusing on cash flow, focusing on ways you can invest in tax efficient ways, finding good people that you trust and are way smarter, wiser, and are specialized
to get access into these
to
kind of alternative investments.
Right. Yeah. Because I think just the access to information and just, it's like we're not in an information economy anymore. We're in a wisdom economy is what I heard. And I thought it was amazing, right? Because there's so much information out there. It's like, it's mind numbing. It's like, what do you do?
Right.
What do you do? It's like
information overload. I need somebody to help with me. So I need some wisdom here.
Yeah. You need some wisdom. You just need a couple of people you look up to, whether it's like you're an uncle that was successful, or maybe it's a friend's dad or mom or whoever it is. Re-engineer their life. Like, what did you do? What would you do now?
Totally.
And start to, and you got to just be patient. One of the things that I've kind of run into, and he's been around forever, is like Dave Ramsey. And so I've always heard him like, I don't know about all that stuff, but I just went on a kick and I read a couple of his books and listened to some podcasts just a couple of months ago. But I took a lot of great nuggets from that. And so you just kind of take a little bit of everything and then you make your own based on what's your risk tolerance, who you are, what's the future you want to have, what is fulfillment to you, right?
It's taking ownership of your life.
Yeah.
Totally.
You know, and
defining it.
Becoming an active player in a space. You know, like you don't have to go into all the markets. You don't have to do all that. You don't have to become an expert in the whole thing. You just need to pick a lane, pick a successful model, somebody that you can take on or will be your mentor, or even like, I mean, gosh, there's so much information that if you pick a lane and just stick with the lane for a while, you'll find out a ton of information. And there's so many cool mentors, even online and YouTube now. I think it's the era of going into a particular direction really deep versus spreading it out. And you will be, over the long haul, you will be winning and rewarded for the fact that you chose and focused indefinitely. And then you'll wake up 20 years later and be like, wow, I've learned so much in this space. And then you become a professional or an expert in that space. Now you are valuable. I just listened to that Patrick Bet-David book. And it's like, at the end of the day, it's very simple. What value are you bringing to the marketplace? Yeah. Like if anyone on your team or in your company, or you're working for somebody and you're like, well, you know, I want to make 200 grand a year, but I'm only making 100. It's like, okay, well, how are you going to perform and become that valuable to make the 200 grand?
Right.
We have a lot of investors. I mean, we're having a conversation. What do you do with $10 million? If you have $10 million that you're placing, you're a killer, right? We know that. And we also have a lot of young people that really want to get into investing and doing all this kind of stuff. But if you're the person who's worked really hard, but you stuck with the same job, maybe you made, you know, $75,000 to $115,000 a year, and you've been just putting money in your 401k over and over and over again. You're hearing it from here. We all would have some money in real estate. And when we say real estate, we don't mean a REIT in your portfolio.
No.
We mean some type of income producing real estate that is a tangible asset that over time is going to appreciate, and you're going to get that gain benefit.
Yeah.
And so whether it's with us or whoever you end up investing with, just start to do some research, because I think that the stats are it's something like over 90% of millionaires attribute some of their success to holding real estate. We have the average American retiring with less than $50,000 in savings. The average American has tens of thousands of credit card debt. And so if you're one of these people who are like, what do I do? We're telling you, we're hitting you over the head with a baseball bat. Look at real estate. We got 90, 60, 60, and this guy, and it's like, we're all in real estate. Start looking at real estate because it's such a benefit.
I appreciate all of you. We're in the era of being grateful, Christmas, the reason for the season, Jesus Christ. Thank you. We love you, buddy. We are excited for the future, and great run, guys. It was a great year, and we're looking forward to an amazing next year, 2025. Let's go.
Let's go. Fun.
Onward and upward.
Great. Yeah. Cheers, guys.
Cheers.
Bye.